Well, good Friday morning. This is Rich Morrison, and welcome to my latest edition of The Thinking Cap, where today we're going to talk about price charts and where a lot of these markets are trading right now, why it's a big deal, why we need to be focusing on the charts, picking out some points to be making some sales. It is that time of year. We talk about seasonals a lot, and when you look at the timing of this year right now, we're moving right in, we're moving right into that seasonal period where the markets typically give us our best chances to be able to make profitable sales. And you look at the history of corn on the top left, soybeans top right, cotton bottom left, spring wheat bottom right. This May, June period is usually the window we get our best opportunities to make sales. In the crop insurance business, we always preach taking your bushel guarantee from the policy and utilizing that bushel guarantee. If you buy 80% coverage on, say, 200 bushel APH, you've got 160 bushel guarantee. Use that guarantee to go make some sales when the market rallies and gives you that opportunity. And this is the time of the year where we usually get the most uncertainty. We get weather uncertainty. You get acreage uncertainty. We're finishing up the South American harvest, seeing some issues there in the Rio Grande do Sul soybean crop, maybe losing some bushels. So all of this is adding some fuel to the fire. The funds buying into the market, buying back some of their short positions. So timing is very important right now. And certainly we want to take advantage of it. So I wanted to spend a few minutes going through each of the charts here as we head into the weekend. First of all, July corn, looking at old crop corn, pretty obvious here on the right-hand side of the chart. We have pushed up into a new recent high. Here yesterday, we were able to trade up to the purple line, which is the 100-day moving average. Today, here at the open, we were able to trade through it. We've traded above the March high. Now you're staring back at the January peak at the end of January at 471. That's up another 7 cents. If I've got old crop corn left right now, maybe you put a target in around 470. Maybe you look at the 200-day moving average up here, this light blue line at 487, maybe 480 to 485. I'd want to put another target in. A few things to point out on these charts, and I'll show you the next slide. I'll have these labeled, but the red line is the 9-day moving average. The blue is the 20-day. The gold is the 50-day, the purple is the 100, and the blue is the 200-day moving average. And you can see these shorter-term moving averages, of course, they tend to move a little bit more. The long-term tends to be pretty solid. And like the 200-day, we haven't been above it really. You've got to go well back into last year before we've been above that 200-day moving average. And so that's a long-term trend. And as you start working your way down into these shorter-term moving average lines, of course, they tend to move a little bit more. At the bottom of the chart, the relative strength index, the stochastics, both of these are indicators of a ascending or descending market, the volume that gets moved in these markets. And usually when the RSI gets up around 70, 60 to 70, that's a sell signal. When the RSI gets down into the 30 area, that's a buy signal. You can see we haven't had a sell signal in quite a while, or really. But you look at the stochastics, and they move a little bit quicker, and so they're a little bit of a confirmation. You go back to this March peak, and back in October when the markets turned lower, they kind of give you a confirmation. And if you look at these lines today, the stochastics are 91, 81, RSI at 64. That means this market's probably getting a little toppy. And it wouldn't be a shock to see us correct down to the downside. So this is a time where you want to put your offers in, get some of that rest of that old corn sold. If you still want to stay in the market, consider going and buying an out of the money call option, short dated option against December corn. I've written about that a few different times. There's a lot of different ways you can stay in the market. Looking at December corn. Got a lot of lines on here. I've got these moving averages labeled, so you can see we've traded above the 100-day moving average over the last couple of days. We've traded this morning, we've traded above the March high at 481. That kind of opens the door to several things. You've got the 200-day moving average at 495. We had a chart gap that was left back at the beginning of the year from 502 and a quarter to 503. To me, those would be some good upside targets to consider. In addition to this 480 level, I think I might have mentioned that in the last market report. or in the last aftermath, that you get up around this 480 level, not a bad place to start trickling out some new crop sales. The RSI is down at 61, 62. Stochastics pushing up into the 90 area, which tells me, historically, this is a time when the markets tend to peak out a little bit. So travel with, caution going forward, but certainly you want to put some offers in. A few things I would point out here on this chart. Number one is the crop insurance price at 466. Basically by selling corn today at 483, you're increasing your revenue that's guaranteed on the farm versus what you had from your insurance policy. You're being able to add another 17 cents times your bushels that you sell. So if you were looking at, say, $800 guarantee, now you're improving that. So that's one way to look at it. And I think from a marketing perspective, I always try to market when I can above this insurance price. The margin protection price, those that bought it back in the fall, we were looking at it as a put option. And it's been working for us for a lot of this last few months. Now that the market's back up, we're not back at that price yet, but certainly you've got some guaranteed revenue there. You can go ahead and lock in some of these bushels as well. So I don't know what's going to happen when you get into the heart of the growing season. No one does at this point. We know the funds are short, but as they're buying back, we certainly want to take advantage of the opportunities we get. And as you look at the RSI and stochastics today, probably tells us not a bad time to be looking at starting to put some sale offers in. Looking at July soybeans, the big driver here has been the soybean meal market over the last couple of days that's driven beans up. Now, not to the extent that corn has. We haven't been able to take out the March high yet. We're trading about 15 cents below the 100-day moving average line, this purple line. What's it going to take? For old crop beans, the majority of the South American crops in the bin, the Brazilian crop was 90.5% harvested as of last weekend. That said, you've got some southern Brazil beans that are in standing water right now, and they're probably going to lose. I saw an estimate this morning, maybe 1 million metric tons. So we'll see if that's the case, but that's an issue, I think, that has supported this bean market, and it's given us an opportunity. Again, the RSI at 59, stochastics pushing back up into the 80s. I think this 100-day moving average at 1222, along with that high in March, probably some pretty good targets to consider here. Looking at November beans, busy chart here, I realized, because I wanted to go back and show that low from last year. But a couple of things. We're able to improve on the insurance price today, about 40 cents almost. We're above the 100-day moving average line. We're well above all these shorter term moving averages. So I think some targets, up around this 1210, 1215 area. Number one, I think the 200-day moving average at 1234, not a bad place to have an offer in. That's pretty close to where this chart gap was back at the beginning of the year, 1237 to 1244.5. So those would be some areas you might want to consider. Look at switching over to wheat. Looking at Chicago July wheat. We've bounced the last three days. We're not quite back to the recent high at 633.25, but we are well above the 100-day moving average. But this 200-day moving average line, kind of a lid. It was a lid here a week or so ago when we tried to rally. We bounced back down. Now here we are challenging that again. A couple of things fundamentally to point out. The Russian crop is getting a little bit smaller. The European crop is getting a little smaller. The Australian crop is getting a little smaller. So not that the U.S. crops are at this point changing much, if any, at this point, but we're starting to see some fundamental reasoning why maybe you're seeing some funds buying back some of their shorts here. So this 630 area, not a bad place to start looking at some sales. Maybe I'll look back at the November high at 666, which is also at the crop insurance price. So that 660 area, probably a pretty good level to be looking at Chicago wheat. Kansas City wheat, very similar looking chart. We pushed back up close to the 200-day moving average, close to last week's high, around 662. Not a bad place. Again, look at the RSI last week when that high was made. We were up in the 70s. Stochastics were up in the 80s, 90s. Market corrected a little bit. Here we go again. So not a bad place to be looking at trickling off a sale. Again, look at the crop insurance price, 734. probably be a great place to be having some offers in just in case this market pops up a little bit. Minneapolis new crop wheat, that spring wheat market has continued to trend higher. But again, I had this in my hot zone yesterday. The RSI up to 72, stochastics in the 90s. This market getting a little bit toppy right now. So travel with caution if you're unsold and going forward here. But 720, not a bad place to start. We're above the insurance base price that was set back in February, still well below the margin protection price, but the 720 to 740 area looks like a pretty good place to be trickling off some sales here for next year's new crop. Finally, switching over to cotton. Cotton's been the weakest link lately. Why? I think it has a lot to do with the funds. The hedge funds have been long cotton for a long time now. They've been struggling to get rid of it all. We've seen that over the last year. When the funds have been long something, they tend to get out of it, especially in the ag world. And we've seen massive liquidation. We saw it last year in corn, soybeans, and wheat. We've seen it in the cattle market a couple of times. Now you've seen it in the cotton market over the last 2-3 months, and it's caused a lot of pain, certainly in this cotton market. But that said, as of a week ago, these funds were long, still about 9,000 contracts. I'm guessing as of today, they've gotten rid of it all. And I think this 75-cent level holds. The RSI down to 21, stochastics in single digits. This would be a buy, in my opinion. And so with the stock market firm today, I look for the cotton market to bounce back. I don't want to be a seller here. If you've sold already and you want to re-own it, I think it's a great place to re-own the cotton market. I would look for some upside here as we go forward. And the same in the new crop. We've traded down over 10%. Why is that important from the crop insurance standpoint? Well, if you had Stack's insurance policy this year, Stack's is a 90% county policy, and 10% is about 8.3 cents. And as of right now, we're sitting down a little over 10%. What does that mean? Well, it means that if my county were to have an average crop this year and the price stays where it's at right now, that you'd be looking at a potential Stack's indemnity payment just based on price loss. Now, I'm not convinced that it's going to do that, but the policy is, I would call it, in the money as we speak right now. So we got a long way to go with yields and with price, but the policy is providing you downside at this point. So I don't want to panic and make sales. And in fact, this would be a buying opportunity, I think. The RSI at 22 and stochastics at 3 and 5. This thing's way overcooked to the downside. So I would, again, look for some upside potential in this market. Where do we go from here? I think this 80 to 81 cent area, the 100 and the 200-day moving average, that would be a target if I had to put some targets in to make some sales. And so probably leave it at that at this point. Switching over to the livestock market, cattle market, for all the volatility we've seen over the last several months in the cattle market, things have kind of started to slow down and kind of wedge together. And you see that with this pennant formation that the charts have kind of formed here in August live cattle. Things have kind of squeezing together a little bit. And so the highs and lows are kind of coming together. Which way will it eventually break out will be interesting. But you look at all the moving average lines now, they're kind of starting to squeeze together from 173 to 179. We're sitting at 173.950 this morning. Stochastics and the RSI pretty neutral right now. So I don't see a play necessarily in the cattle market today. You go back and you look at the indicators, though, over the last few months, we've had several times where, you had these indicators very high, which told us we should be making some sales. We've had a few times where we've been oversold to the downside. So, it's given everyone an opportunity, whether you're a buyer or a seller, to do some marketing in this market. From the farmer standpoint or the producer standpoint, I still like the LRP insurance program as a way to be able to provide basically a put option that the government's going to help pay for. I think it's a good way to put a floor into this market. And so I would look to utilize that again. If we get maybe up to 180 to 185, be an opportunity to be able to put some floors into this market. Same with feeder cattle, similar looking chart. The wedge is kind of formed together. The pennant's kind of coming to a point. Eventually we'll break out one way or the other. That said, pretty neutral right now, the stochastics and the RSIs. So Again, probably, the top end of this thing is around 250, or excuse me, about 270, a little bit below 270. So you get up around that 265 to 270 level, probably not a bad place to be utilizing the LRP policy again to put a floor under the August cattle market. Looking at the hog market, I moved my picture down a little bit. Hogs were stagnant for months, and then finally, we had a double bottom on the chart. Finally, things perked back up. When the cattle market went down, hogs started to rally. We were seeing really good retail demand, I think, in pork, and I think that eventually came to the surface, and you saw some good buying here. And now we've had several really good marketing opportunities, it would appear. Now is not one of them. Markets have come back down off the recent high. RSI at 43, stochastics kind of moving more into an oversold type situation. So we look for the recent low at $100, probably hold this market. You get back up around that 105 to 110 area, probably not a bad place. Again, look to use LRP if you're not a direct hedger in the market. I invite you, if you don't already, to look at my market report email letter in the evening. In the market report, I have this heat check column over here where we talk about the hots and the nots, which markets are hot, which markets are not. Last night, we had Minneapolis wheat, we had soy meal, we had corn. All of these had RSIs over 60, stochastics up into the 70s, 80s, 90s. Those are the markets we need to be focusing on making some sales. And I mentioned a couple of D's corn today, kind of moving into that as well. Some of the knots right now, the hog market we just talked about, the cotton market, those are the markets I do not want to be a seller of right now. If you wanted to re-own them, not a bad place to do that. So check out this column each day, and we'll continue to keep you updated there. Even if I don't show the charts in the letter, I try to keep you up to date on which markets are ones that we need to be paying attention to. So with that, I appreciate you taking the time to listen to this edition of the Thinking Cap. Take care. Hope you have a great day. We'll talk to you again very soon.